we need to understand what trading is, the concept of trading, the history of trading, what we need to know about trading in the global financial market. So I am your instructor for today. My name is Michael Oluwasegun Akinrata. So let's get started. Okay, now, what is global financial market? Does anyone has any understanding of global financial market? Have you heard the word global financial market before? So we're going to talk about it. Global financial market refers broadly to any marketplace where trading of financial instruments or security occurs. Yes, it involves, it's defined as any marketplace where trading of financial instruments occurs. So what are the marketplace? What are the keywords in this statement? We are talking about marketplace. We all know what a marketplace is, where we buy and what we sell. And trading of what? Financial instruments. So what is financial instrument? We have streamlined this marketplace, not just a marketplace where every activity happens, but a marketplace where what? Financial instruments occurs. Does anybody has anything to say? Hello? Okay, so if you have anything to say, kindly chat, put it in the comment section, then you have access to that. So what are the instruments? What are the financial instruments that we are talking about? We are talking about instruments such as what? Bonds, currencies, commodities, equities, indices, including what? Volatility index. We have what? Major cryptocurrency and other derivatives. Okay, so we have simplified it in the next point that the instruments that have been traded, the financial instruments that have been traded in the global financial market, we have bonds, we have currencies, we have commodities, we have equities, indices, major cryptocurrencies, and other derivatives. So let's talk about the next point. The next point says the global financial markets rely heavily on informational transparency to ensure that the market sets prices that are efficient and appropriate, which are practically governed by forces of supply and demand. Now, let me explain this third point to us. Hello? Hello?
Hi.
Can you hear me?
Yes.
Okay, that's great. So let me explain this third point. This third point states that what moves the market, that the market is based on efficient law of what? Supply and demand. Now, let me explain this for us. In economics, we've been taught supply and demand. And you should know that if the demand of an object or the demand of whatever you want to buy increases and the supply falls, what will happen to the price? The price will rise. Why? Because if we have in a place, when we have enough buyers than sellers in the market. Hello? Hello? Okay, so in a place when we have enough buyers than sellers in the market, then whatever it is, in a place when we have enough buyers than sellers, everybody wants to buy a particular item. And if anybody wants to buy a particular item, then, and the number of people that are selling the items are not much. And the number of people that are selling the items are not much. So what do we have? We have the people, the less number of people that are selling this item, we want to increase the price of this particular instrument. Hello? Hello?
We are hearing you.
Oh, okay, that's great. I need confirmation. Okay, so what am I saying? I'm saying that if the suppliers, if you have a lesser number of suppliers that are selling the particular instrument, and we have a lot of people that wants to acquire that particular instrument, when that means that demand is rising and suppliers are not much. So what will happen to the price? Literally, the price will increase. And same thing that happens to that when we have much suppliers and we have lesser number of people that wants to buy a particular item, it will be very cheap. When the supply is much, when we have enough sellers for a particular item and we have lesser buyers, everybody wants to sell it off at a very cheap price. So this law, these forces are what drives the market. They are what drives the market. So everything you are buying, you are trading in global financial market, we are trading governing by the forces of supply and demand. Okay, so if everybody wants to buy an instrument, it means that at that point in time, we have lower sellers, much buyers, the price will increase. And if we have much sellers and smaller buyers, what will happen to the price? The price will fall. Okay, so let's go to the next slide. Now let's talk about types of financial market. We are talking about types of financial market. We are talking about stocks market. We are talking about over-the-counter market. We are talking about bond market. We are talking about money market. We are talking about derivatives. We are talking about commodities, cryptocurrencies market. Then what? Spot market. Spot market is also known as what? Forex market. Okay, so out of all this market, spot market is also known as what? Forex market. So these are the types of financial market that we have. Okay, so let's go to the next slide. Now, what are the main functions of the financial market? We need to know the functions of the financial market. So financial market exists for several reasons, but the most fundamental function is to allow the efficient flow allocation of capital and assets in a financial economy. 2, by allowing a free market for the flow of capital and financial obligations and money. 3, the financial market makes the global economy run more smoothly while allowing the investors to also participate in the capital gains over time. So these are some of the functions of the global financial market. Does anybody want, if you have anything to say, kindly type it while we continue. Hello? Hello? Okay, so if you have any question, can you put it in the comment section? Okay, so now let's talk about the history of the market. What are the history of the market? We need to understand the history of the market. Today, the spot market is one of the biggest, most liquid and accessible markets in the world and has been shaped by several important global events like Bretton Woods and the gold standard system. So what does this mean? It means that, we could remember when we talk about the types of markets, we are talking about Forex market. So it means that the spot market is one of the most biggest and the most liquid and accessible markets in the world. Yes. Do you know the price of the amount that flows around the market every day is $6.6 trillion. That's the average amount that is paid to $6.6 trillion. So let me explain this. It's telling us that in spite of what has passed through global financial market, we also witness or we notice that there are a lot of things that did not affect or crumble the market system. In spite of the Bretton Woods, the gold standard system, the market still stands. Okay, and the second point says, and it's important for traders to understand the history of the market and the key historic events which have shaped the market. Yes, it is very important for us to know the history, the historic events that have shaped the market. Now, this is because events could likely occur again in different and similar forms, impacting the trading landscape. Hence, history repeats itself. So what are we talking about? We are saying that in spite of this, we need to know the structure of the market, what it has been through, what it is at the moment, and what it is going to be, because whatever happens in the past will also repeat itself in the global financial market. Okay, so let's talk about another history of the market. Trading, which is the act of exchange is thought to be centuries old, dating back to trade by barter system before the Babylonian period, which ushered in the use of gold coins. So this is part of the history of the market. We can trace the history of the market to what? To the era of trade by barter during the Babylonian period. Then the second point says gold coins became widely accepted as a medium of exchange, but they were impractical because they were heavy. So we talk about the history of the market, we talk about trade by barter, we talk about from how markets moves from the Babylonian era to the gold coin era. And these are some of the disadvantages of using the gold coin. Okay, so these are some of the disadvantages of using the gold coin because they are what? They are very, very heavy. Then in this 18th century, countries adopted the gold standard system. Yes, so this is to tell you that after the Babylonian era, when they were using, before the Babylonian era, markets where people were doing exchange, trade by exchange, this is called trade by barter, and the Babylonian era came in. After the Babylonian era came in, then the gold standard system came in. So in the 18th centuries, countries adopted the use of gold standard system. So if they want to make international transactions as at then, they peg their value of what they want to buy or sell to the value of what? Gold. And you know that this gold is very heavy. It is not durable, and it is not easily movable from one point to another. So let's talk about this gold standard system. In the 1880 to 1914, currencies valued in terms of their gold equivalent. So they are telling us that between this period from 1880 to 1914, they are valuing the worth of every currency to gold equivalent. Now, in the mid 1870s, in the mid 18th centuries, most major economies pegged to gold. Yes, so this is saying that from 1880 to 1870, the most economies in the world was pegged to gold. So all currencies live together in a system of what? Fixed exchange. Okay, so we are talking about the usefulness, the disadvantages, the adventure of markets from the trade by barter era down to the gold standard system. And we know that in 1880 to 1914, they were telling us that a lot of countries adopted the use of what? The gold standard system. Now, the system had no flexibility. So let's talk about the disadvantages of gold standard system. The system had no flexibility to adjust money supply in times of economic crisis, such as natural disasters, war, recession, etc. So this is telling us one of the disadvantages of the gold standard system. So in such situations, the system had to be repeatedly discontinued. So they are telling us that because gold standard system, because gold is not flexible, and inflexibility during the times of natural disasters, war, recession. So a whole lot of countries were looking for another avenue, an alternative to discontinue the use of gold standard system and also find a new way of international monetary system. Now, to avoid the negative effect of reduced money supply, countries will break the equality between the gold reserve and money supply, thereby diluting the system. So this is to tell us that the major step that each country will take when it comes to using gold or probably diluting the system, the process it takes for diluting the system, the gold standard system, as you can see that it is a very, very tasking process. So these are part of the disadvantage. And because of that, most countries now resort to what we call Bretton Woods Agreement. Okay, so Bretton Woods Agreement, before the end of World War II, the Allied nations believed that there would be a need to set up a financial system. Yes. So you could see that because of the disadvantages of the gold standard system, a whole lot of countries, they now came together then after the Second World War, they came together that they want a new financial system. So in July 1944, 44 countries sent delegates to a conference held in Bretton Woods, New Hampshire in the United States of America to deliberate over what to be called the Bretton Woods System of International Monetary Management. So in 1944, 44 countries, they came to US, to talk about what they could do, the way forward on how they could use money or how they could change the gold standard system. So to simplify Bretton Woods-led formation of the following: one, a method of fixed exchange rates. So when we are talking about this, okay, so I'll come again after that. So when we are talking about the gold standard system, so a method to simplify the Bretton Woods-led formation of the following: first, a method of fixed exchange rate. So it was the resolution of this agreement that the 44 countries agreed to use a fixed exchange rate. So it was after this, when people have resolved to use a fixed exchange rate, then the gold standard system is going in what? Is going in extinction. Okay, so the second is that the US dollar replacing the gold standard to become primary reserve currency. And you know that in the previous slide, we talked about gold reserve. Now, in 1944, in July 1944, the US dollar replaced the gold standard to become a primary reserve currency of the world. So as at then, instead of them to use gold or to equate their value of their currency to gold, they rather use what? US dollars. So it was from them that US dollar became very popular, and United States of America became very rich, and they attained to the height of world power since 1944. Now, as at then, two agencies were also created. The creation of two international agencies to oversee economic activities, which is the first one, International Monetary Fund, which is IMF. So IMF was created in 1944. The second is the International Bank for Reconstruction and Development. So these two agencies were created as a result of what? As a result of Bretton Woods Agreement. So because of the request of one of us here, he said we should go back to parallel to disadvantages of gold standard system. So this is one of the disadvantages. The system had no flexibility to adjust money supply in terms of economic crisis, such as natural disasters, war, recession, etc. So in such situations, the system had to be repeatedly discontinued. Now, the second one is to avoid negative effect of reduced money supply. Countries will break the equality between gold reserve and money supply, thereby diluting the system. So these two are one of the key points and one of the key disadvantages, aside from gold being heavy. These are part of the economic disadvantages of gold standard system. Okay, now let's talk about the history of the market. So we need to talk about the history of the market. So from the beginning, we talk about the history of the market in aspect of from the evolution of trade by barter to receipt, that the Babylonian era to era of using gold coin. Now, from gold coin, we talk about switching to US because of the Bretton Woods Agreement. So they started using what? The US dollars, and they replaced the US dollar they replaced the US dollar for a gold standard system, making US dollar the primary reserve currency of the world, down to the beginning of the free floating system. At this point, does any one of us have a question? If you have a question, kindly type it in the chat box, then we continue. Okay, so the beginning of the free floating system, it did not take long for traders to realize the potential profits in this new world of currency trading. Even with government intervention, there still were strong degrees of fluctuations. And where there's fluctuations, there is profit. So what does this mean? It means that we can never have a straight movement in every economy. So economy or the currency of a country has fluctuations, and it is also affected by government policy, by taxation and all. So this creates imbalance in the movement of the price, and this causes fluctuations. And look at the phrase, they said where there's fluctuations, there is profit. Yes, in trading in the global financial market, you have the opportunity to make profit when the market is going up and when the market is coming down. So that is fluctuations. So when the market is going up, and you probably with the analysis, you could buy low, and when it's high, you could also sell when the market is high. So that gives you two-way opportunity to make money from the global financial market. Now, this became a little clear over a decade after the collapse of Bretton Woods. So now let's talk about the internet trading. In the 1990s, the currency market grew more sophisticated and faster than ever because of money, and how people viewed and used it was changing. A person sitting alone at home could find with the click of a button an accurate price that only a few years back would have required an army of traders, brokers, and telephones. So these advances in communication came during a time when former divisions gave way to capitalism and globalization. So this is also to tell you how market has evolved from the gold standard system down to internet trading. So with this, you can sit down at the comfort of your home and place a trade, and you can also make profit from the trade that you have placed. So now let's go to the next slide, which concludes the history of the market. So with no backing in gold for all the currencies of the world, this meant that the exchange rate between them could not be calculated arithmetically. Rather, the value of a currency now depends on a variety of factors, most of which are under the control of government of each nation. Hence, there is a need of a market where the exchange rate will be determined on a real-time basis based on the information flowing through the market. So what are we talking about? We are saying that we are trying to compare or juxtapose the relationship between the gold standard system, or the differences between the gold standard system and the currency. So we see that currency is flexible, while gold is not what? Flexible. And what affects the flexibility or the movement of the currency? It's the policy of government, as I said earlier, natural disasters. So all this will also cause fluctuations in currency or in the economy of the country. So that is where Forex market came into show. Okay, so let's talk about history of the market. As you can see, that it has been proclaimed that Forex market is the backbone of modern economy. Yes, this is the backbone of modern economy. You can check Google. Google has also authenticated. So it's the backbone of what? Modern economy. Now let's talk about who are the participants in the Forex market. We need to know who our participants are. So the first participants I'm going to talk about are the central banks. When I'm talking of central banks, I'm talking of big central banks of developed country. Central banks like Bank of England, we have Bank of Japan, we have Reserve Bank of New Zealand, we have Bank of Australia, Bank of America. These are central banks. Then after that, they also participate in the Forex market. And after that, we have the institutional investors. These are hedge funds, the big investors, investment companies of the world. They also participate in the global financial market or in the Forex market. Then we have the commercial banks like JP Morgan, like Barclays. So these are commercial banks that also participate in the Forex market. We have companies, manufacturing companies like Toyota, like Coca-Cola, etc. So these companies, they also participate in the global financial market. Then we have brokers like Pacific Union. Majorly, that is what we do. We also participate in the global financial market before we have the individuals, which is you and I. So we individuals, we are also called the what? We are also called the retailers. We are also called the what? Retailers. And you can see that even in chain of manufacturing chain, the retailers are the least. They are the least in the what? In the chain. So you and I can also have access to trade or to participate in the Forex market. Isn't that beautiful? You are participating, you are in the same market that big central banks are. You are in the same market that commercial banks are. So you should know how important and how huge Forex market is. Now let's talk about the market session. So on this, if you don't understand, please, I need you to lay comments in the chat section, then I'll view it and also repeat and answer all our questions. Now let's talk about market sessions. You know, we talked that the global financial market, that word global means worldwide. So it means that almost all nations, all continents in the world participate in the Forex market. And because of that, every country is being grouped into time zones. I group it into time zones. So I'm going to talk about these zones, and it is also called sessions. Now, unlike other financial markets, the Forex market operates 24 hours in a day and 5 days in a week, starting in Sydney, then Tokyo, followed by Europe session, which is London session, and finally America, which is what? New York session. So we have Sydney session to be the first, and the New York, which is America, to be the last in the chain. So the market opens late on Sunday evening and then closes late on Friday. Now, what this means is that market only runs 5 times in 5 days in a week, which is from Monday to Friday. But due to time zones, you know, like what we have here. Now, what we have here, this is the time zones. We have from 11 p.m., 12 p.m., 1 a.m., 2 a.m., 3 a.m., 4 a.m., and it goes down back to what? It goes down back to 10 p.m. So this is 24 hours. And because of the time zones, market opens on Monday morning, 8 a.m., but because of the time zone, Australians Monday morning, it's our own 10 p.m. in Nigeria. So this time zone is made basically according to our own time zones. So that is why you see market open by 10 p.m. at night on Sunday and closes very late on what? On Friday. Okay, so from Sydney, from 10 p.m. in our own local time to 7 a.m., we have the Sydney sessions. Then from 12 a.m. to about 10 a.m., we have the Tokyo sessions. Then from 8 a.m. to about 5 p.m., we have the London session. And from 1 p.m. or 12 p.m. to about 10 p.m., we have the New York session. So these are the 4 sessions we have in trading in the Forex market. Okay, and for more inquiry about it, you can go to www.forexfactory.com. That is our reference and is a legit site that gives legit information. So this is the time zones for all the countries, and you can see, and it is grouped into 4. So we have Sydney and Tokyo, we have London and New York sessions. Okay, so let's go to the next slide. Now, what are traded in the market? What are traded in the market? So we have currencies, we have stocks. When we are talking of stocks, we are talking of Facebook. We're talking of stocks. So you can also trade Facebook, can trade LinkedIn, can trade all our social medias, the shares, that is stocks. You can trade Forex, you can trade commodities, you can trade indices, you can trade cryptocurrencies in the Forex, in the global financial market. Now we are going to talk about this one after the other. Now let's talk about currencies. Now, so when we're talking about currency, the most traded currency by value is what? Is the United States dollars. So US dollar is what is the most traded currency by value, and which percentage is about 87.6%. Wow. So you see that out of all the currencies in the world, US has about 87.6 tradable percentage. So you should see how popular US has become ever since the BRexit Agreement era. Now, after US, we have Euro to be 31.3, and after that, we have Japanese yen to be 21.6%. Then we have the British pound to be 12.8%. We have the Australian dollar to be 6.9%. We have the Canadian dollar to be 5.1%. We have the Swiss franc to be 4.8%. Chinese yuan 4.0, Mexican peso 2.2, Swedish krona down to South African rand. So the least tradable pair, or the least tradable currency is what? Is South African rand, and the most tradable is the United States dollars. Now let's talk about major currencies. So when we are talking about major currencies, these are currencies of major countries, developed nations in the world. Okay, so we are talking about major currency. I want us to learn this symbol and the name of the currency and their nickname, because we are going to come across it while trading, while making money from the global financial market. So the first we have the symbol, which is what? USD. This, we should be familiar with that. And the country is United States. The name of the currency is dollars, and the nickname is called buck. So the second we have is what? Is the euro. Then euro is being spent by Eurozone members, that's countries in Europe, and the symbol is EUR. So when you say EUR, then you should know it is what? The name of the currency is euro, and the nickname is what? Is fiber. Now JPY, the name of the country that spends JPY is Japan. So the JPY is a symbol of the currency of Japan, and the currency name is yen, and the nickname is also yen. Then we have GBP, which is Great Britain or Great British Pound, and the nickname is what? Cable. We have CHF to be Switzerland franc, and the nickname is what? Swissy. We have CAD to be CAD or CAD to be Canadian dollars, and the nickname is what? Loonie. And we have AUD to be Australian dollar, and the nickname is what? Aussie. Then NZD to be New Zealand dollar, which the nickname is what? Kiwi. So these major currency are 8 in numbers, and they have their symbols. And because they are currency of countries that have stable economy in the world, their economy has been stable for hundreds of years. So they are now categorized as what? Major currencies. Okay, now we talk about currencies. Now let's go to commodities. Now, talking of commodities, this pie chart shows that this commodity is subdivided into 3. So we have the energy, and under the energy, we have the natural gas, we have the WTI crude oil, we have the Brent crude, we have the heating oil, and the unleaded gas. Then after that, we also have metals. Metal is also part of the subdivision of commodity in the market. Okay, so metals like gold, like copper, like aluminum, like silver, like nickel, zinc. So these are examples of what? Metals. Then we have agriculture, which is corn, soya beans, coffee, sugar, live cattle, wheat, and other agriculture. So these are also examples of instruments under agriculture that are part of commodities in the global financial market. Okay, so we also have indices as well. Can also trade indices in the global financial market. We have major cryptocurrencies. And the beauty of it, that all these instruments mentioned are traded on pacificunion.com. I mean, on our brokerage firm, that is www.poolprime.com. So you have access to all these instruments listed here on our platform. Okay, and talking of cryptocurrencies, we've also added some major cryptocurrencies to our platform, which enables you to have more access to trade cryptocurrencies with Pacific Union. So you can always have access. So if you don't want to trade currency, if you are interested in trading commodity, you have access to it with Pacific Union. If you are interested to trade cryptocurrencies, you have access to it in Pacific Union. If you are interested to trade indices, you also have access to it in Pacific Union. So you have a wide range of instruments that suits your trading appetite and your trading style. So we are coming back to major currencies. Why are we coming back to major currencies? We are coming back because we want you to understand and know these major currencies offhand. So when you know it by heart, you'll be able, and you memorize the symbol. When you want to trade or pick trade, you understand the type of currencies that we are trading. Okay, so the major currencies we have the USD, which is the symbol. We have the United States dollar. We have the symbol as what? USD, and the nickname as what? Buck. Then we have the EUR, which is Europe. This is Euro, and Euro is being spent by Eurozone members, that's countries in Europe, and the nickname for Euro is fiber. We have for JPY, which is Japanese yen, and the nickname is what? Yen. We have GBP, which is Great British Pound, and the nickname is what? Cable. We have CHF, which is Switzerland franc, and the nickname is Swissy. We have CAD, or some people calls it CAD, which is Canadian dollars, and the nickname is what? Loonie. We have AUD, which is Australian dollars, and the nickname is what? Aussie. We have NZD, which is New Zealand dollar, and the nickname is Kiwi. So these are the 8 major currencies that we have in the global financial market. So in this session, I hope you understand what are tradable in the global financial market, especially on our platform. We have currencies, indices, commodities, stocks. We have shares, we have bonds. So whatever you want to trade is accessible. You have access to that with the global. We have access to that on our platform on Pacific Union. You have access to that. Okay, so now let's talk about trading in pairs. So I hope you understand that trading are done in pairs. And what does pair means? Pair means involving 2 persons. Like we have these 2 personalities shaking hands together. We also have the sign of euro and dollar. So these are example of what? This is just a graphical illustration to tell you that trading are done in what? In pairs. Okay. Now let's talk about categories of currency pairs. It is very important that we know the categories of what? Of currency pairs. So we have the major currency pair, we have the cross currency pair, and we have the exotic currency pairs. Okay, so we have 3 categories of currency pairs. We have the major, we have the cross, and we have the what? Exotic. Okay, now let's talk about the major currency pairs. Remember, if you can remember, I told you about the 8 major currencies that we have in the world. So basically, when you are pairing these 8 major currencies with United States dollars, it makes it a major currency pair. Why? Because United States dollars happens to be the most traded currency in the world. So if you are now pairing a major currency with United States dollar, then you know it's a what? Major currency pairs. Now, example of major currency pairs we have.
Wait, I'm in a Zoom meeting. When I finish, I'll come.
Hello. So example of major currencies that we have the Euro USD. You know, if you can remember, Euro is a major currency. Am I correct? Class, am I correct?
You are right.
Okay, then we have Euro USD, we have USD JPY, we have GBP USD, we have USD CHF, we have USD CAD, that's USD CAD, we have AUD USD, we also have what? NZD USD. So you can see that these currencies this euro, we have euro, JPY, GBP, CHF, CAD, Australian dollar, New Zealand dollar. These are major currencies. And what makes it more unique is when you pair one major with United States dollar, it becomes a major currency pairs. So if you want to, you know, if you don't want to be calling it Euro USD, or you want to have a geek speak with it, just for people to, you know, you're a very good forex trader, you can call Euro USD Euro dollar. You can call USD JPY dollar yen. You know, GBP USD is pound dollar. USD CHF is dollar Swissy. USD CAD is what? Dollar loonie. Then who can tell me what AUD USD means? I mean, if you just want to give it a geek speak, you can call it what?
Aussie dollar.
Aussie dollar. That's great. Then NZD USD, you can call it what? Kiwi dollars. Now let's talk about these major currencies. What are they? These major currencies, they are the most liquid in the world. Yes. You know, when you're trading, markets needs to be very, very active. So we'll use liquidity to explain the high level of activities, the inflow and outflow of currency, of volumes of currency in the financial market. So if you heard that major currencies are most liquid, you should know that yes, they are highly what? They are highly tradable in the financial market. Do we understand what major currencies are? Okay, so let's talk about cross-currency pairs. Now, you know, we talked about major currency to be a major currency that is paired with US dollar. Now let's talk about cross-currency. Now, cross-currencies, cross-currency pairs, they don't contain US dollar. They are known as cross-currency pairs, or simply as the word crosses. So if you have 2 major currencies that are not paired with US dollar, they are called cross-currency pair. Are we together? Okay, so they are called, hello?
I'm hearing
Hello,
you.
we are hearing you.
Okay, that's great.
Yeah,
So
yeah,
they're called crosses. They are called crosses. So while not as frequently traded as the majors, the crosses are pretty still liquid and still provide trading opportunities. So, you know, if you are trading two major currencies, aside from US dollar, with the absence of US dollar, then you are trading in crosses. So they are not as traded as the majors, but they are pretty liquid because, and they also provide trading opportunity. Now, out of these crosses, we have most tradable crosses, which are the Euro Cross, the JPY Cross, and the GBP Cross. Okay, so we have the Euro Cross, the JPY Cross, and the what? And the GBP Cross. Now, let's talk about Euro Cross. Let me explain what Euro Cross means. Euro Cross is when you cross Euro with any other major currency without US dollars. So when you cross Euro with another major currency aside US dollar, it's called Euro Cross. So example as well, Euro CHF, we have Euro GBP, we have Euro CAD, we have Euro AUD, we have Euro NZD, and so on and so forth. So when you pair Euro with a major currency aside from US dollar, it is called Euro crosses. And when you pair Euro, we also have GBP crosses. This is when you pair GBP, that is Great British Pounds, with any other major currency aside US dollar. It is called GBP crosses. So these are examples of cross-currency pairs. So we have other currencies, could be AUD CHF, AUD CAD, AUD NZD, CAD CHF, and so on and so forth. Okay, now the third one is the exotic currency pairs. The exotic currency pairs are made up of one major currency paired with currency of an emerging economy, such as currency of Brazil, of Mexico, Chile, Turkey, South Africa, or Hungary. So what does it mean? It means that when you pair one major currency with an emerging currency, that is currency that are not major currency, if you pair them together, they are called exotic pairs. So these pairs are not as heavily as traded as the major or crosses. So the transaction cost or the spread associated with these trading pairs are usually big. So what does it mean? It means that they have a low tradable volume in the market. So they are not easily traded, and that is why their spread are relatively high. Okay, so these are examples of other crosses that we have. Now let's talk about most actively traded currencies. You know, we have a most traded currency. Now we have the most actively traded currency pair. That is the currency pair that is actively traded in the world, or in the global financial market. So the first one is Euro USD. Euro USD has about 28%. Then we have USD JPY, we have GBP, which is about 14%. We have GBP USD, which is 9%, AUD USD, 6%, USD CAD, 5%, USD CHF, 4%, Euro JPY, and Euro GBP, they are what? 3%. And the last one in the category are what? Are others. So this tells us that Euro USD is the most traded currency pair in the what? In the global financial market. Now, what do you need to start trading? These are things that you need to start trading. The first, you need your personal computer or your PC or a mobile phone, a smartphone. So you need that. Then secondly, you need a stable and high-speed internet connection. So aside from computer, you also need a high-speed internet connection. Then the third one, you need limited funds. You need a limited fund. Then you need reliable and trusted forex brokerage firm, which is Pacific Union. So I know that in this generation that we are, everybody has these 4 criteria. So if you have this 4 criteria, there's nothing stopping you from trading and making money with the global financial market. Okay, so let's talk about how to trade. The concept of trading, what you need to know about trading. So there are 3 things that are very important when it comes to trading. The first is the entry, The second is the stop loss, and the third is the take profit. So what is a stop loss? A stop loss is you telling your broker or your broker to know how much you are willing to risk with your trade. You know, like what we have here, we have this man, he wants to buy, and his stop loss is below his buy, which means that if probably the price is going against him, instead of him not to lose or to have a heavy loss, he should take little loss out of his what? Out of his trade. So after a loss, then the thing you need is what? A profit. So most times in Pacific Union, we try our possible best to make our traders highly profitable. So once you are very profitable, that is why we offer the best training services, the best signal, the best trading services as well, so that we want you to be what? To be profitable. And that is why Pacific Union is more than trading. So a take profit is you always telling your broker how much you are willing to make as a profit with one trade and close when you're happy with it. So this means that basically if you are buying and the price is going up, you need to take your profit. Remember, we talked about fluctuation, so that once you take profit hits, your profit will be taken and be added to your balance. So if you are not there, Pacific Union has your back. Once you set your price for your take profit, they help you close the trade so that your profit will not fluctuate again and move against you. So the third is the entry price. A entry price is the price at which you execute your trade to either buy or sell. Okay, so your entry price should either be when you execute your trade to either buy or sell. So before you place a trade, you need to know why you are trading. With your analysis or some informations or data that you've collated, it will tell you either to buy or to sell. So these are the three things you need to know. Your entry, this is you want to buy or you want to sell. The stop loss, telling your brokerage firm to help you close your trade if the market is moving against you to some extent, and take profit if the market is going in your direction. The brokerage firm will help you close your trade in profit. Okay, so like you can see, this is an example. When you place a trade on your chart, this is what you see. So this is what you see when you place a trade in your chart. Okay, so with this, I hope I've been able to give us brief introduction about the global financial market. If you have any questions, kindly put it in the chat box while we answer your questions. Hello? Hello? Okay, so in the absence of any questions, I really want to appreciate you for joining the class. In the next sessions, we are going to talk about how to place a trade, what the currency pairs means, the base currency, the quote currency, how to place a trade and all. So our online classes is on Wednesdays and Fridays, 12 to 1. And at this time, we give you good information, good trainings on how you can be profitable from the global financial market. Thank you very much. Please, if you have a question, you can drop it on our group, and also you can drop it on our chat, in the chat box. We are going to provide necessary answer to it. Have a nice day.